All right, no course, no gimmicks, no games. Let's get right into it. Here is everything you need to know about call options in just a few minutes. Chances are, if you clicked on this video, you know what the stock market is. So whether you've been in the market for a while or you're someone completely new to investing, this will be the perfect video to either teach you or to provide a refresher on what exactly call options are. Let's start with the definition. Call options are best defined as a contract that gives the buyer of the contract the right but not the obligation to purchase a specific asset within a specific time frame in exchange for what is called a premium. Don't worry, we're gonna break it down more. So the contract we are talking about is this little guy right here. Now it doesn't look like the typical contract you think of when that word pops into your brain, but it still is a contract. And one option contract gives the buyer the ability to purchase 100 shares of whatever company, in this case it's Chipotle, at a predetermined price that is agreed upon by the buyer and seller, known as the strike price. All the strike price means is that the seller will sell 100 shares to the buyer of the contract for the price that they agreed upon. Let's make it pretty easy with an example. So imagine that you are the buyer of a contract and I am going to be the seller. This contract is saying that I, the seller, will agree to sell you 100 shares of Chipotle at $68 a share, the strike price, on or before December 20th, which is known as the expiration date. But as the seller, I am not going to do this out of the kindness of my heart. I need compensation for this contract, which is where the premium comes in. So, for the right to a contract, you, the buyer, will pay an upfront fee known as the premium to me for the rights. So, for this Chipotle call option, it would be $330 total or $3.30 a share. Again, 100 shares for one contract. So, let's take this example in two ways. Scenario one, let's say Chipotle jumps up to $75 a share in December, and you, with your contract, have the legal right to buy those 100 shares from me at the agreed upon strike price of $68. Let's say you decide to buy these shares off of me. This is known as exercising the contract. So to calculate your profit off exercising this contract, you will take the current share price of the theoretical $75 minus the strike price of $68 multiplied by 100, which gives you the difference in 100 shares, and then subtract the premium off of that, and then you're left with your profit. Since you paid me that premium up front, I am legally obligated to sell you those shares. So I sell you my 100 shares for a total of $6,800, which is the strike price times 100 shares per contract. Keep in mind, these 100 shares are worth $7,500 on paper. So you just got a $700 discount on 100 Chipotle shares. And of course, the ability for you to do this came from when you paid the premium to me. So this is a powerful example of exactly why you would want to exercise a call option contract, but that's assuming the stock goes up. Let's say the stock doesn't go in the direction you want, and this will bring us to scenario two, when you would not want to exercise a contract. Let's say December rolls around and Chipotle is not above $68. Let's say it's trading around $65, and this is where the right but not the obligation part of the contract comes into play. Because if you executed this contract right now, you would be paying above market price for my 100 shares, which really makes no sense at all. So the alternative to not exercising the contract is that it expires worthless. December 20th rolls around, you decide not to exercise, and the only downside to you as the buyer is you lost the premium that was paid up front, that $330. And so in this situation, your max loss as the buyer of a contract will only ever be what you pay for the premium. In a nutshell, those are call options. Let's quickly recap and break down the key points. So, a call option has three basic important components to remember. The strike price, the price that you are agreeing to buy and or sell. The expiration, how long the contract is good for. And then finally, the premium, the fee that the buyer will pay for the right but not the obligation to buy those 100 shares at the expiration date. It's important to remember that call options are a bullish strategy, means you think the stock price will go up. And so it is common practice for people to buy contracts on stocks that they think will be going up in the future so that they can get a discount. And the final thing it's really important to remember is that as a buyer, your max risk is going to be the premium you paid to the seller. In summary, a call option is a way to potentially profit from a stock going up without having to shell out for 100 shares of the underlying. Call options offer flexibility, leverage, and defined downside risk. Exercising a call option contract is not the only way they're used in the stock market. There's another way in which you trade discrepancies on premium price at a given point and you do not hold till expiration. This is called options trading. The benefit is that it requires a lot less capital and can generate some absolutely crazy returns. but there is a lot more risk. If you're interested in learning more about call options in its own separate video, I have a video that you can click right here to watch it, and I'll even go through a whole week of trading with it. And so there you have it, call options explained in just a few minutes. Hit the like button if you want to, and keep in mind my channel is focused on entrepreneurship, the stock market, and general cool stuff. So if you're interested in anything like that, make sure to subscribe. I have cool stuff coming out every single week, so you guys should really be around for it. Thank you. Have a good day.